Hello, ladies and gentlemen, and welcome to our webinar on trend trading. Now, today's webinar is sponsored by CMS Trader. That's Capital Markets Trader, one of the world's leading providers of CFD and Forex trading. And our class is also powered by investing.com. You know, where you signed up today to attend the class. Now, CMS Trader is a regulated provider, so I'm therefore required to read you a risk warning. So let me get through that and then we'll get on with our class. Trading Forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risks and take care to manage your exposure. Now, if you want during class today, you can go to www.cmstrader.com and just click on the buy or the sell button, fill out a couple lines of information, and you'll have a demo account open for you almost instantaneously. And you can follow along on their charts as we go through class today and see how you would trend trade. And then you can use their demo account to try out your trading skills. Now, if you can't access cmstrader.com, it means that they are not regulated in your country and therefore do not offer trading because they only offer their services where they are regulated and approved by the government. Now, there's many ways or reasons you should trade with CMS Trader. Because of their education platform, they spend a lot of time and money trying to build the best and provide the best education. They give you guaranteed security. All your funds are secure in a way. They have impeccable service, and they have simplicity in trading. They have an incredibly great online dynamic platform. You also get free daily signals, free daily market updates, technical analysis. You also get unlimited access to all their different trading platforms. You can trade a wide range of instruments with CMS Trader, including Forex and CFDs for stocks, commodities, and indices. You can also use their watch, copy, and profit module, which allows you to watch and copy their most successful traders on their platform. You don't need any experience. You just join their social trading and then follow what their traders are doing with one click of a trade. You decide how much you want to invest, but you can follow along and just do exactly what their top leading professionals are doing. You can also learn how to become an independent trader with CMS Trader. They have video tutorials for beginners and professionals. They offer one-on-one sessions with financial experts and a full library of ebooks. So we're going to get started today with our trend trading webinar, but I first got a couple of other things I got to share with you. First of all, I've uploaded 2 handout guides, one on trend following strategies and one on trends and trend lines. You need to download these now because they are not available at any other time and they're not available from any other service. They are just available during our webinar. Also, today during class, we're going to be taking some polls. These are simple little polls to help me do better webinars and figure out what you all want and need to see in other classes. There is no personal data being asked for. Nothing ties back to you. There's no credit cards, no personal information. All you have to do is whenever a blue screen pops up, click on the appropriate answers, and we'll continue on with the webinar while you're doing the poll. We're not going to stop for it, but we'd appreciate very much if you fill out the information, just click on the correct answers, because all we're doing is tabulating, coming up statistics to help us make the experience better for you. So in fact, I'm going to pop one up right now so you can see how simple they are. And as I said, they're not attached to you at all personally, and we're not asking you to do anything. And just click on the appropriate answer as we continue on with our trend trading class. Now, trend following is perhaps the most popular long-term and mid-term strategy in all the financial markets. As a trading strategy, it is exceedingly effective and profitable when the conditions are favorable and is quite straightforward in its methodology. Now, we should note that the technical aspect of trend following is in fact quite simple, but it also requires, before everything else, discipline, sound money management, and patience of a trader. And risk management is always the key to being successful in the markets. Just because a strategy works now and then doesn't mean it always works. You need to always protect your butts. You need to always understand the risk, put stop losses in, and know how to get out of the market if the market's moving against you. Trend following is not a short-term method, and patience and determination are as important as correct analysis as a result. Trends are created by powerful underlying economic factors, which may not be clear to those who are not familiar with the fundamental analysis. But the simple patterns created by the price action in response to the economic events can often be identified through methods that are easy to learn and apply. Thus, the retail trader like you and I has a much higher potential success, or has as much potential as the experienced analyst if he can control his emotions and behave logically. Now, to give you a perfect example, it's almost 2 years ago, but when we had the Brexit vote in London, and it surprised everybody by being exactly opposite what the poll said, we knew the minute that that result came out that the pound was going to collapse. Now, if you were a short-term trader, you could have jumped in the market and taken high-risk trades to trade the pound to go down, and immediately that next day, I mean, there was no liquidity in the market because everybody was selling the pound. But if you were a trend trader, you would have seen that pound was going to trend down over a long period of time because we had a very definitive economic factor. And you could have sold that pound to slowly go down over the next couple weeks, the next couple months, and it's still relatively low today. It's never recovered back to the 166 level. Now, to apply this strategy, we must be aware of the existence of trends, because a trend following strategy is based on finding an asset that is trending. And a trend, although it is a general movement, because a trend in a financial market is no different than skirts getting shorter, cars getting bigger, colors moving to reds and greens from oranges and pinks. Okay, they are simply trends, not fads, but trends in the marketplace. But they can be seen and understood. And when we can see a true trend, not a fad that's going to hit and miss for a couple days, but a true trend, okay, and establish this trend, we can then take advantage of that to make smart trades. So without identifying a trend, we would just be gambling. Okay? And that's not the purpose of trading Forex and CFDs. Both fundamental and technical analysis can be employed for identifying a trend, and both of them have their advantages and drawbacks. It is in general a good idea to use a combination for deciding for a trend's character and deciding on our entry and exit points to the market. Because once we've established that there is a trend, okay, we can establish if it is a solid trend, if it's a short-term or long-term trend, and if it's a defined trend. What we're looking for is we're looking for only high probability trades, because we only want the trades that are going to give us the best results. So therefore, we want to find assets that are in very well defined, identifiable trades, because you don't need to make 1,000 trades. All you have to do is find a few assets here and there. And it's very easy to look on the financial charts to quickly see which assets are trending. So let's go up and let's take a look. I got some live charts up here for you. Let me pop up a chart here for you. Okay. And let's go over, since I've mentioned pound, let's look at the pound. Okay. Now this is a fairly short-term chart, it's a 1-hour chart for the pound. And we can see right now when we look at it, that pound is really trending. Now, understand there are only 3 types of trends. There's an uptrend, a downtrend, and a sideways or congestive trend or range-bound trend. This would have been considered a sideways trend here. Then we moved into a focused downtrend. And this is a beautiful downtrend because price doesn't move in a straight direct line. Price moves in peaks and valleys, lower lows and higher lows, push and ease, push and ease, push and ease, push and ease. These can be considered waves, impulse waves, be part of an Elliott wave pattern, but they are the peaks and the valleys that are created during trading. Because trading, remember, is made up of millions of human beings actually making physical trades. Now, if you stop and think about the psychology again about trends or about trading, what we do is if you thought the pound was going to fall and you sold the pound here, okay, as the pound fell, there's also buyers sitting over here looking for a place to enter. There's also the people over here that already sold the pound that already decided they just want to make a couple points profit. So this group, okay, is sitting here saying, the pound fell too low. It's too cheap to buy right now. We're going to sit on the sidelines. This group over here said, look at that. I entered the market here. I'm going to sell and take my profit here. Okay, this forms the first peak and valley because what happens is these traders get sidelined. It just means they moved over because they say the pound's too low to sell right now. So they're just sitting on the sideline. This guy is sold off to book his profit. He's thrilled to death. He's made his couple points profit. Well, that allows the market to ease back up and form this retracement. As the market eases back up and gets a little bit higher, and this is a downtrend, it's just the opposite for an uptrend. This group says, oh, well, guess what? The pound has moved up high enough that I will sell it now. And they come re-enter the market. This group of sellers has already been sold out. They're gone. They're closed out their positions, and they're maybe re-entering the markets also. And it allows the pound to move back down on its previous, or resume its previous trend. And we can explain this in very simplistic manners, and that's what we're doing. But you don't need to overcomplicate it. We could make it very, very complex. But the fact is, for a trend trading strategy, you don't need it complex. Period. End. You could use all kinds of Fibonacci level support and resistance level, all kinds of indicators, but you need it relatively simple. Okay? You don't have to overcomplicate it. Okay, because a trend trading strategy is fairly easy. You want to identify points of entry and exit during a trend. So we wanted to first is figure out if we can find and see a trend. And we did that here. From here, we need to go on to a little bit more information. So we do this through general observation. That's not complicated. General observation of the market swing points is the first point of call in determining if a market is trending. If you do not see a pattern of higher highs and higher lows, or lower highs and lower lows, depending whether it's an uptrend or downtrend, but instead you see sideways price movement with no obvious general up or down direction to it, then you're probably looking at a range-bound market or one that's just top chopping around and isn't developed enough for trend trading. So once we finished our observation, we want to understand if the trend is doing what it should be doing, because we found an asset that's moving up, or we found an asset that's moving down. So we found an asset that's moving up. You shouldn't have to think too hard about whether a market is trending or not. Okay? Most traders make trend discovery way too difficult. If you take a common sense and patient approach, it's usually fairly obvious if a market is trending and not just looking at raw pieces of information in its chart. Make sure you mark the swing points on your chart, as it will help draw your attention to them and help you see if there's a pattern of higher highs and higher lows or lower highs and lower lows. That's it. Okay, that's all we're simply looking for. Now, you also need, once you've identified and said, okay, this market is trending, this asset is trending, this is an asset I would consider as part of my making a trade in. I don't know whether at what point to enter it, but I see that the market is moving in an upward or downward fashion. So the next thing you have to do is first choose whether you want to employ technical or fundamental analysis for your method or a combination. Now, this is important. Okay. A lot of people will trend trade from fundamental news, like Donald Trump says something, okay, or an economic piece of data, a piece of economics data comes out, or something happens with Saudi Arabia and oil. The fact is, this can help somewhat because if you see an uptrending market and the news that came out is supportive, it can help it move up. But the fact is, without technical analysis and the use of charts, you'll never actually be able to define the entry point, the price you want to enter the market. You'll never be able to do your risk reward ratios to determine whether you want to make this trade and if the market has enough to move to make it worthwhile. So the easiest and best is a combination of simple things like looking at the economics calendar, listening to central bank comments, using trend lines, basic support and resistance levels, and one indicator, maybe, and my preference is MACD, but could be Bollinger Bands, something basically easy to do, fast and not a great deal of time and effort. Because all you're looking something is something to, number one, verify that you have a trend, something to help you identify when you want to enter the market, and something to help you identify your risk reward ratio. Now, my ultimate favorite is support and resistance and trend patterns. I love trading triangles, but that's my personal preference. But you have to decide yours. Now, fundamental analysis can provide you with information which can predict the strength and the length of the trend. It is possible to base your strategy on one of these to the exclusion of the other, and it's still possible to turn a profit if you are lucky. But our principle has always been to reduce the role of luck to as little as possible. Fundamental analysis is more reliable than technical analysis in defining a trend that has long-term potential. But without technical analysis, it would be extremely difficult to decide when and how to trade. Now, technical analysis sounds like a big, complicated word, and it can be. Okay. But technical analysis incorporates a whole bunch of different analysis types. Simple charting is a technical analysis. Technical indicators like RSI and stochastics and MACD and CCI are technical indicators. They're just a small part of technical analysis. I like to use momentum. I swear by volume because I need volume on my chart to let me know if all the other traders are jumping in the market or whether they're afraid of what is happening or they're not accepting it. And like I said, I personally like triangles, head and shoulders, volume, and MACD. I've got my entire trade system right there. It takes me a minute or two to do the analysis. So I suggest that you use both technical and fundamental methods for your trend following strategy, with fundamental factors eliminating the false signals of technical analysis and technical tools providing you with time price frames for deciding on entry points. So how do I decide the existence of a trend? There are many technical tools that can signify the phenomenon, but there are equal number of false signals generated by them. Remember that there are only three kinds of trends that exist at any time: flat, up, or down. And it's possible to speak of trends between any 2 points on a price chart. Simply take two random points on a chart, draw a moving average on it, and the pattern that arises can be analyzed as a trend. Thus, it is always necessary to have at least a basic understanding of the economic factors that create the trends before deciding on the validity of a chart pattern. Now, what kind of price pattern will create a trend? We keep talking about this: lower lows and lower highs in a downtrend, higher highs and higher lows in an uptrend. So one of the best tools for identifying a trend and confirming a trend's movement is a simple moving average. This simple moving average will help you actually take the noise out of the markets. So a 9 period, a 12 period, a 15 period, a 20 period moving average, because all it does is let you see where price is moving. It also gives you an indication when price breaks above or below the moving average. Then if you're using candlestick charts, we simply look for price to create higher highs and higher lows above and below that moving average. What is a higher high? Well, in this case, in a downturn, we're looking for lower highs and lower lows. So a lower high is simply the highest point created in that price sector. So we look for, in a downtrend, to price to make a lower low. In other words, in its push, it forms a lower low. And then when it retraces slightly, it makes a lower high. Because this high, at this point, when it's making this retracement, does not exceed the previous high. It then continues on to make a lower low as it's putting its next thrust, and then moves back up to make a lower high. The high being the highest price in that sector, staying below. So this gives us the zigzag of the market. Let me just get my markings off of here for you guys. Okay, so if the trend can be identified visually, why use technical tools? So even though we can notice the existence of a trend, we still need technical tools to trade it. Okay, trending markets tend to make strong moves in the direction of the trend, followed by periods of consolidation or a counter trend retrace, or simply called a retracement, before the next leg in the direction of the trend. You will notice this pattern happens in almost any trend you find. Typically, what happens to many traders is they will make some money during the period of a strong directional trend movement, but then they will continue to trade as the market takes a breather from the trend and consolidates. It's these periods when traders give up all their gains they just made when the market was moving aggressively. You need to learn to identify the different parts of a trend, and this will help you avoid over trading during choppy consolidations and for panic selling when the asset goes into a small retracement. Because if you understand the movement of trends, you understand you can trade the market here. That's a very easy trade to make, depending on where you entered and where you exit. But when you've got to cover your spreads and your costs, you don't want to panic sell when it dips down here. You want to understand that this is a retracement and want to verify and continue watching it very closely to make sure it is a retracement, not a reversal, and then wait for the market to move up. Because even if you were to sell out somewhere here, look at all the profit you would have been given up. Okay. And so each time, and this market can do this many times, if you panicked each time it sold, you would be selling short. You'd be selling a profit, but a lot smaller profit than what you should have been trading for before. And remember, whenever we have a good trade, we need to maximize our profit so that we can cover the times when we have losing trades. Now, we can see that a trending market tends to move in spurts, moving in the direction of the trend and then stalling to take a breath before another leg. Now, all the trends are obviously not exactly the same, but we do typically see the general pattern described above as a forceful move in the direction of a trend followed by a period of consolidation or retracement. Uh-oh. There we go. Sorry about that. Now, these retraces are when we have the highest potential for a high probability entry within the trend. Remember earlier I mentioned high probability trades only. Often, a market would trace to approximately the level of its previous swing points before the trend resumes. If an uptrend, these swing points are support, and downtrends, they are resistance. Look at the diagram over here on the right. Let's look at the chart we just looked at this time and look at the levels of support and resistance. So the markets will usually retrace back. So market pushing up, hits what we call a resistance level, bounces down and comes back to its previous support level. Okay. And it will most likely come to one of its major support levels and then retrace back off of that. Move back up, and now here we can confirm because now this resistance level is broken and it becomes our support level, pushing us up to the next resistance. Price comes back down to what is now our support level, moves back up, bounces through it. And when we see one of the entry points we might establish is when it breaks that next resistance level. Also, the support level helps us where to put our stop loss points. Okay. Sounds simplistic, but it works. Now, what it comes down to is market timing is everything. Market timing never works when one is trying to predict reversal points on a technical basis. So you'll never be able to predict exactly where that price is going to finish its retracement. Okay, because it doesn't stop on a dime. It doesn't stop on a time. So like when you use a Fibonacci retracement tool, it could retrace 23.6, it could retrace 38.2, 50% or 62%. We have strategical levels at which we want to, which we feel comfortable with while it's making a retrace, and then other ones that make us panic. So if we have major and minor support levels on our charts, brought across by major swing highs and swing lows, and for pivot points, we know where a normal retracement should go. And when it's not stopping that retracement at a level, maybe that's telling us, okay, we're not sure what's happening here, but maybe it's an exit point. So timing is very, very important because you can't do anything this precisely. There's also other technical indicators that will help you understand how to time your trades. So one of the best tools for trade following are supplied by moving averages and simple price charts. A 3-period moving average, a 10, a 20, and a 30, or a 30, 60, and 100, okay, can work very well. MACD, which is moving average convergence and divergence, okay, can work as a very good support piece of information. It's also possible to use moving average crossovers and a myriad of other methods. But whichever you choose to use, you should ensure that you do not complicate the main aspect of your strategy. And that's simply trading that trend. So which time frame do you recommend for a moving average? Now, if you want to trade on a weekly or daily basis, the 100-period or 100-day or 100-period moving average will probably be able to capture most of the important trends for you. If I'm trading Forex and CFD trading in and looking for trend trading, I use a 30, 60, 90, okay? Or I'll use a 9, 12, 20. It depends on how short of a term trend I'm looking for. Anything with a longer period is likely to be meaningless because too much data is discarded, and any time frame that is too much below 100 may be too sensitive to price action. But as usual, one can use other time frames below 100, provided that he doesn't clutter his screen with lots of indicators, charts, and tools. So on your screen, you see an absolutely beautiful trend following strategy that's using simple moving average crossovers and is using a weighted moving average using an 8 period and a 14 period, combined with support and resistance levels and a simple RSI indicator down below. So we have candlesticks, we have moving average crossovers, and we have a combination. So read the notes on here. Okay, now once you've decided what method or strategy you'll use, and I've given you some of this in your handouts, it's important to determine where your stop losses and where your take profit points are. Now, this partly depends on the nature and the term of the trend following method. A stop loss order can be placed a short distance above or below the trend line, whether it's provided by a moving average or a simple line drawn on your chart. In my opinion, the trend follower should not realize his profits until he has a good reason to do so. Because if you believe an asset is trending and moving up, you just want to stay in that market while it continues to move up and take as much as you can. But you need to have moving strategies to help you. If you're using a moving stop loss or to continue moving up your stop loss as that asset moves in your favor, as that trade moves in your favor, so a quick reversal doesn't stop you out, but you need to keep your stop loss far enough away that you don't get stopped out in a simple retracement. But the purpose of the strategy is to focus on underlying price dynamics by stripping out volatility and short-term movements. And there's little logic to realizing profit in response to fluctuations which are irrelevant to the main action of the trend. So this trading method involves a risk management component that uses 3 elements: the number of shares or the number of CFDs you're trading, or the size of your trade, and the current marketability and the current market price. Okay. Price. One of the first rules of trend following is to price is the main concern. Forget everything else. The only thing and the first thing or the most important thing you should be paying attention to is the price on the chart. Period. The end. Too many people get involved in all types of strategies, and when this does that, when price action and price on a chart is still the ultimate dominating factor. So here we simply have price on a chart and is price trending. That's it. Traders may use other indicators showing where price may go next, and what should be put on a general rule should not be disregarded. The trader need only be worried that the market is doing, not what it might do. The current price and the only price tells you what the market price is and what the market is doing. Money management is also one of the most crucial factors that you can use, because it's easy to enter a trade. It's easy to exit a trade. It's not easy to trade a small amount and stay in the markets and minimize your risk and not get overly emotional. To only keep a certain amount of money in that market, so if the market turns against you, you don't get wiped out. So another decisive factor of trend following is not the timing of the trade or the indicator, but rather the decision to how much to trade over the course of the trend. Risk control. Risk control cuts the losses in the rule. This means that during periods of higher market volatility, the trading should be reduced. So if the asset starts to get more volatile, even though it's still moving up, you need to get some of your trade off the table. During losing periods, positions are reduced and trade sizes are cut back. The main objective here is to preserve capital until a more positive price takes over or the trend starts to move in our favor. And then rules. You should always have rules. Trend following should be systematic. Price and time are pivotable at all times. This technique is not based on an analysis of fundamental supply and demand factors. So in Forex, bearish and bullish trends are typically equal, as violent and potent, whereas in equity markets tend to see slower moving price action in a bull market along with lower volatility. So it is said in the Forex market that a asset that moves down will then eventually turn around and move back up to the same point where it was a long time ago. The downtrend is usually the same strength as the following uptrend, where stocks don't move. Stocks will move up, they'll ease down a little, they'll find a new level, they'll ease down where. So you note on the chart how the down and the uptrend were the same in their volatility and their price action. That's one of the reasons we use Fibonacci retracements, because Fibonacci retracements use the prior trend and segment it based on the next trend being equal in the previous trend. Now, position size is important, okay? Because do you reduce? How do you decide how much? How do you decide how much you're going to invest? Understanding that is very important. But there's an old adage that says the trend is your friend until it isn't. So you need to determine how you will enter and exit. But again, more importantly, is how to limit your risk and how to apply risk management to your trade so that you can last in the market, and how to trust the trend. Now you can go down and learn Elliott waves. You can learn impulse waves. There's all different things you want, but you have to learn to believe in the trend. Push, ease, push, ease, push, ease. Your motto should be higher highs, higher lows, lower highs. And as long as you see that, you should be comfortable in following that trend till that trend is dying out. So again, I firmly believe in triangles, support and resistance, volume, MACD. That's all I need. Once I've got it, moving averages, well, MACD applies moving averages and moving average crossover. But also a moving average crossover strategy for trend trading is another good way to try. So don't make it overcomplicated. Use the handouts I gave you. Understand the trends and trend lines, and then understand trend trading strategy and see if it works right for you. And again, if you go to www.cmstrader.com, open a demo account. Like I said, there's no credit card required, no deposit required, and try out on their charts. Try finding a trend, try identifying, trying to see if you could trade that trend and take advantage of it, and try to figure out where you'd have to put your stop losses to protect yourself based on the amount that you could risk, and see if you can work out how to follow a trend. And on that note, I'm going to say goodnight and thank you very much, or good afternoon, and thank you very much for joining us. We appreciate it. And again, thank you for supporting CMS Trader and investing.com. Bye now.